Hello and welcome to the Burns School Building a Better Way video series. Today we're so grateful that Glenn Miller is here with us. Professor Miller has more than 43 years of experience in the real estate industry and more than 33 years of experience researching the industry. Glenn, thanks for being with us.
Thank you.
Talk a little bit about how you even started in real estate 43 years ago.
Okay, well, actually my undergraduate degree is from University of Denver in finance and off to the East Coast because of high unemployment back in 1975, did my MBA there, came back, and my first job was at United Bank of Denver, which is no longer, but Broadway and 16th was where I worked, and by chance got thrown into the real estate group, so I spent 2 years underwriting loans for real estate development deals and investments, and then went out on my own and started my own construction and development company.
Fantastic. So talk a little bit about, you have been researching real estate cycles for years. How did that start? How did you get into the research side of it?
Okay. Well, after about 7 years of construction and development, decided to go back to school, get my PhD, and actually came back here to DU in 1986 and taught for 4 years. Then I got hired away by Prudential Real Estate Investors, who were the largest investor in real estate in the United States back in 1990, both for the insurance company and as an advisor to big institutional investors like pension plans and endowments. And so, and as a matter of fact, Colorado PARA, Public Employees Retirement Association, was one of my big clients back then. And for those old enough to know, 1990 was a year when we had both an economic crash and a real estate crash. And so when I got to Prudential, they said, figure out what happened, why, and if we can figure out how to forecast it in the future so we can make better investment decisions and development decisions. So that got me plotting down a research track that got me to the fact that real estate goes through cycles just like the economy.
So describe exactly that. What is a real estate cycle?
Okay. Well, what I found was real estate really has kind of two parts to its cycle. The physical cycle, which is demand and supply for real estate. So a lot of people getting jobs, needing office space, for example, in the city of Denver, based on the industries that are here. We call them economic-based industries that drive growth for the local economy. So when you have a good or a service that you export outside of the local economy that brings money in, you're an economic-based industry. For us, it's things like information and technology companies are growing very, very fast. It's obviously the oil and gas industry, and so every city has something different. Detroit, Michigan is obviously automobiles. So if there's a lot of demand for office space and we're not putting much up, occupancies are going to rise and rents are going to go up. So that's the physical side. Demand and supply for real estate is very local in nature. The other side is the financial cycle, and the financial cycle is just like the stock market. If a lot of people want to buy, capital flows in, prices go up. If people don't want to buy, capital doesn't flow in and prices go down. They should move fairly closely together, but don't always do that. And that's why I separated them back in 1992 when I first started all this cycle research.
So you track them totally separately?
Yes.
Okay. And I think you hinted at this, but talk about why you analyze cities separately.
Right. Well, again, each city has a different economic driver and also has a different level of construction. So, New York City is obviously financial services, all the big stock companies and everything else. If they're doing well, demand in New York City is going to grow. Now more tech companies are moving into New York City, so that's a new economic base industry for them. So what's happening in New York is different than northern New Jersey. What's happening in, I'm going to try and find two cities close together. What's happening in San Francisco is very different from what's happening in Los Angeles or even San Jose, which is even closer to San Francisco. So there is that local demand, and obviously a new building in San Francisco is not going to affect what's going on in San Jose.
Sure. Talk a little bit about property types.
Okay.
Because it sounds like, could be very different depending on what you're investing in or what you want to build.
Right. So there's basically 5 major property types in real estate, or as I say, 5 food groups. Office, industrial, typically warehouse, retail, everything from a regional mall to a grocery anchored shopping center, apartments, and hotels. So those 5 income producing property types are what most investors look to. Lots of sub-property types out there now, like medical office buildings. In apartments, there's senior housing, people that are that rent when they're much older. In industrial, there's self-storage. So there's all these different sub-property types out there as well. But those 5 major property types are what I cover in my market cycle reports.
And talk a little bit about how these reports help investors, other people.
Sure.
How would it help me?
Okay. So when I came to Prudential, part of my job was to research as we went out to find properties to purchase, either for the insurance company or for pension funds or endowments. Our acquisition people would say, where should I go look for good properties? What markets are in good shape? So looking at their occupancy levels and rent growth, each city is moving differently. So are they in the recovery, the expansion, the hypersupply, or the recession phase of the cycle? So my market cycle reports graphically depict where they are. So I can say Denver is in the same place as Austin, Texas, but it's actually doing better than New York City in office. But Denver industrial, because we have this new economic base industry that came around here in Colorado about 5 years ago, legalizing marijuana. All of a sudden, there's a lot of demand for warehouse. So rents went up a lot. And so we started, if rents are high, we can build more space. And so we've actually slightly overbuilt the industrial space in Denver so that we're in the hypersupply phase. Occupancies are starting to slow down a little bit, whereas obviously we've got tons of demand from what I call the Amazon effect from internet sales, et cetera. So every retailer now has to have an internet presence. They has to be able to ship to you very quickly. So they are all, increasing their warehouse space so that they can get you their goods very quickly.
Yeah, we've seen these huge buildings go up around the Denver metro.
1 million square feet plus warehouses.
Enormous. So where are we in this cycle? And does it depend on where you live?
Sure. And what I'll do is, it absolutely does, but what I'll do is I'll use kind of national averages for you. Office right now on a national average is about in the middle of the growth phase of the cycle. We're getting a lot of new demand. We're not putting up a lot of new space. And so the market is growing, occupancy is going up, and hence rents are going up as well. Industrial nationally is pretty much at almost every market in the country, except Denver, is at the peak occupancy level. And you go, well, isn't it about to turn down then? Well, if the economy doesn't turn down, then those don't turn down. And right now, retailers are talking through the fact that it's probably going to take them about 10 years to build out all their internet fulfillment, including Amazon. So it looks like there's a good 5-year, growth demand pattern right now that, we aren't building too much for. So they're at this equilibrium, nice demand matching supply level that's really good for what's going on. Okay. Apartments, the one property type that we're actually overbuilding. We've got great demand growth because all of the millennials are coming out of school, getting jobs, and getting into apartments. They can't buy a house right out of school. And one of the problems is it's the one property type that the government also finances. While they do home loans from Fannie Mae, Freddie Mac, Ginnie Mae, and the VA, they also finance apartments. So we need, for instance, in Denver, we've needed like 8,000 new apartments every year. 2 years ago, we built 3 years ago, we built 8,000. 2 years ago, we built 10. Last year, we did 12,000. So we oversupplied the market. Demand's still there at 8, but when you put up 12, occupancies start to fall off a little bit. So what happens? Landlords start to offer, they don't want to drop their rent, but hey, come in and sign your lease and get a free month's worth of rent.
Sure.
So their net effective rent is actually, their actual income becomes lower. The one surprise property type is retail. Everybody thinks that retail is being killed off by Amazon and all the internet stuff. Internet sales are only 9% of all total sales. And the actual answer is that retail occupancies today are higher than they've ever been in the past 4 cycles that I've looked at, that I've watched over time. So occupancy levels are higher. So, and as we know, Sears just went, is going through bankruptcy, and a landlord in a good mall that has Sears in it is dancing in the streets, because Sears, being the anchor, was paying a lower rent. You're the big guy, you're paying a low rent. They typically had a 20-year lease. Now they're taking that space and they're able to lease it for more than double what Sears was paying. And what are they looking for? Experience retail, because millennials, instead of buying things, want experiences. So have a student in my development class who last year mall down in Georgia, and Sears is gone, and half of that is becoming 2 restaurants, a movie theater, a health club, etc. And on the other side, they're actually going up a couple stories and putting apartments, because millennials want to be able to live and walk right to it. So they're going to more than double their rents with re-tenanting that space.
That's so interesting. I guess I would have thought, they need these anchor stores, but this is actually disadvantage to them.
Right. Yeah, it's changing. The old department stores that sold a lot of everything's become very specialized. So retail is actually doing very well. Here in Denver, it's been doing phenomenally well. Again, because of marijuana, you take an old gas station or an old tiny brick building, and bingo, it's got a green cross on the door now. So our retail here in Denver has been good because of that new tenant coming in. As more and more states get that marijuana stuff, the old, smaller, old space gets repurposed.
Yeah, I'm guessing in a lot of places you see these, strip malls that are, there's a couple decent stores and a lot of the others are kind of.
Grocery stores are absolutely excellent. They are not going out of business. They have expanded and grown in size. And if I've got a grocery store, I need a barbershop, a beauty shop, a liquor store, a mailbox, etc., and potentially a drugstore. So they actually do better in a recession, because people eat out a little less and buy more groceries. So the number 1 and 2 grocer in any region are gonna survive and do very, very well. Of course, Walmart's now the largest grocer in the world. So that part of retail is doing very well. And finally, hotels. The hotel markets, because millennials actually like to travel. My 3 sons travel way more than I did when I was their age. Demand for hotels has been very, very strong. And of course, they are at the highest occupancy level ever. They're above 70%, whereas in previous cycles, they might have gotten into the mid to high 60s. And you go, but isn't Airbnb
exactly
hurting
what I was
them?
Gonna say, yeah.
And the answer is no.
Really?
There's that much. In other words, there's so much more demand that regular hotels are doing better. People still travel for business. We don't do FaceTime business meetings. We still go places for conferences and to meet with clients, because face to face is still very important. We are social animals and need that. Just this year, because of the nice high profits that all these hotels are seeing, we're seeing more construction that was being done over the last 2 years come online. So we're starting to overbuild a few markets. So there are some markets in Denver, just because we've had a couple of new major hotels open, we're just, our occupancy peaked at like 74% and it's dropping off to 73. So it's moving into the hyper supply phase. But that's so demand and supply, occupancies are rising, rents are rising. So the income side of real estate is looking very good.
If I can, I want to quiz you about that a little, because we have that Gaylord Rockies that just opened near the airport, and it's huge. I think it's something like 1,500 rooms.
Correct.
But even that is getting booked, apparently.
Absolutely. Yeah. More and more conferences are being done. People like to get out and do things. And so every city is trying to come up with more conference hotel space. Everybody's trying to expand their conference centers, et cetera, so they can take on bigger and bigger events.
And then back to apartments for a second. It sounds like, so we have a lot of apartments being built in Denver, but do we have enough are they all high end? I guess is what I'm trying to ask. Do we have any low
That's
income
what everybody
and
wanted
affordable housing?
was downtown high end, because that's where millennials wanted to be. Now that those rent prices have gotten so high, millennials going, okay, maybe I'm willing to move a little further away. So now what we're getting is the new deal is go out to one of the light rail stations, buy one of the light rail stations so they don't have to drive, and build a 5-story apartment building with retail on the first floor, so it feels like downtown. And when they do want to go downtown to that concert or, the really cool bars and stuff like that, they can just hop on the light rail and go. So now we're seeing out, off of every light rail spur that's out there, first floor retail, 4 floors of apartment above, in all the suburbs. So we are expanding from that standpoint.
Can you talk about that a little bit? And I don't think I understood that until I actually interviewed your son. But I guess there's some kind of magic to the 5 stories. Like it cost a lot more to construct a larger building. Is that correct?
Yes.
Okay.
Right. And it's a construction technique. Basically, fire code says that, and structurally, you can't build more than 4 floors of a wood structure.
Okay.
Before you have all kinds of extra fire codes and extra costs that get really, really expensive. So what now happens is we build the first floor concrete, so it's basically a foundation above ground. That's fireproof, so I can put parking underneath it or put restaurants that have, that could, kitchens could catch on fire. So I've got a fireproof first floor, and then I got 4 stories of wood frame construction that's much less expensive than steel or concrete to build. So a 5-story building is the sweet spot, if you will, for building these buildings. And also, you don't end up feeling like you're in a canyon, like you do when you walk around New York City.
Yeah. Fascinating. So the next downturn, any thoughts on when it's coming and what people should be prepared for?
That's the really easy question. You tell me when the next economic recession is, and I'll tell you when the next real estate downturn is, because it happens 1 year after the recession starts.
Okay.
I watch all the different economists, and I mean, I remember when they were forecasting in 2012, 2018 is going to be the next recession, and they just keep pushing it out year after year after year. And the most recent, now that we're at the year end, everybody's reworking their forecasts, and they're pushing them out. And right now, the consensus has moved out to like 2022. So we've got another 3 to 4 years of good growth. And demographically, we've got 5 years of millennials coming out of school. And so peak, for employment, et cetera, moving forward from that standpoint, that's really, employment growth to me is the key to driving the economy. And all those millennials, just like, I was a baby boomer in the 70s, we get a job and we spend money and we keep the economy going, because 70% of U.S. GDP is consumers. Mm-hmm. So I think we've got another 3 to 4 years to run yet.
Okay.
In this expansion.
I like it. Anything I haven't asked that you think, people should know or they would be interested in?
Sure. Well, we talked about that physical cycle, demand and supply, which drives occupancies and rents. If occupancy goes up, my income goes up. If rents go up, my income goes up. What about the prices that people pay for this real estate? The financial cycle is driven by capital flows. And with the volatile stock market that we've seen,
very much
people
so
go,
lately.
where can I have a less volatile investment? The bond market is still at very, very low rates, even though the Federal Reserve has raised interest rates. What we look at is a market rate of the U.S. 10-year Treasury, which is not set by the government. It's set by demand and supply for those bonds. And it hit its lowest ever back 4 years ago at 1.6%. And it's slowly worked its way up to about 3% in 2018. Today it's 2.75. So it's a reasonably low rate. And if interest rates go up, bond values drop. So when my retirement advisor, financial advisor at TIAA CREF, which all university professors, that's where our retirement money says, you should have more money in bonds. I go, you're crazy. Because if interest rates go up, from 3 to 4%, the value of my bond just went down. So real estate's a great substitute because it has bond-like income. and not quite as high as stock-like appreciation historically. But investors are looking for that. And in my now 4 decades in the real estate industry, started here in the 70s, it started out commercial or income-producing real estate, office, industrial, retail, apartment, hotel, local buyer, local seller, local bank doing the financing. 1980s, along comes institutional investors, pension funds and endowments, national buyers, national sellers, national financing. 1990s, we get the first access to the public capital markets, REITs or real estate investment trusts, publicly traded companies, raise money in the stock market, buy properties, and commercial mortgage-backed securities, put together a whole bunch of mortgages, sell them out as a bond. Since the year 2000, we've gone global. If I put a building up for sale in New York City, there'll be 20 bidders on that property. 10 of them will be international buyers.
Really?
Okay. And when I look at U.S. real estate, the most expensive real estate in the U.S. is New York office. It trades at a 4% cash-on-cash return. We call that a cap rate. In London, they trade at 2% cap rates. So we look like half off to London buyers. And in Japan, they traded a 1% cap rate. So we look like a 75% discount to them. So international buyers are coming in the United States, and I believe that will help hold prices up.
Glenn, this has been fascinating. Thank you. Thank you for your time, and we appreciate your time today. Thank you for joining us for the Burns series. Also, we should tell you Glenn's information is on our website, right? On the
That is
Burns
correct. My market cycle report that I put out every quarter, go to daniels.edu.edu/Burns School, and my cycle reports are there.
So all this data you heard about, you can access yourself on our website. So thank you so much for joining us.
Right. Thank you.